Hi guys, welcome to this special Market Hotspot education webinar by Trade Genius. Not many traders know this, but today we are sharing with the world a fantastic set of indicators known as the Fibonacci moving averages. Now I'm sure you've heard of the Fibonacci, but how many of you actually use these numbers to build an indicator? Let's begin by giving you some background to moving averages. This is basically a way to smooth out market rates by dividing the closing prices with any given set of time periods, or candles as you know them. For example, the daily candle or the hourly candle, and so on and so forth. Now these averages are used in a variety of indicators. I'm sure you've heard of them. The MACD for one, and also the Bollinger Bands, which many of you traders are probably already using. And if you're not, then do refer to our videos on these averages, as they may really help you with your trading. Before we move forward, just a quick heads up guys, technicals can be applied to many styles of trading, and you should know that. It includes long-term and short-term trading, depending on the individual. Now, whilst there is no right or wrong answer, some strategies may apply more to one style, i.e. long or short-term trading, as opposed to another. And I just wanted to clarify that before we move forward. So long-term averages are generally used amongst the bigger numbers, such as 50-day moving averages or 100-day moving averages time frame. And these can give long-term traders a very good understanding of where the market prices are actually situated, i.e. below or above these averages. Now here's a tip guys, many Wall Street traders will actually look for crossovers in these long-term averages, so 50 to 100-day moving averages, in order to identify a change in trend and begin their positions from these very signals. You can see these crossovers right here in this slide, where we have the 50-day moving average moving from below to above the 100-day moving average, giving that nice buy rally there. So we've glanced at the long term, but this seminar is very much focused on short-term trading and profit taking. And these averages are certainly going to be ones to watch. So without further ado guys, how do we best use these short-term prices together with the averages? Well, what we do is we've come up with a concept where we use a Fibonacci sequence-based number and mixing them together with the averages in order to find such a mechanism. Now we're going to focus on the daily chart guys, okay? As once these averages provide some sort of price direction, these can be traded on shorter term charts following that, such as the 4-hour chart for example. But we are going to stick to the daily chart, okay? So if you're not too familiar with Fibonacci numbers, you may want to watch this video of ours on the Fibonacci through the hotspot that we do already have for you guys. Okay, but essentially what we are about to disclose is how these Fibonacci numbers, a well-known set of frequently occurring proportions in all realms of our lives, just to give you some background there of the Fibonacci, can be used to basically take simple moving averages. So we've specifically picked 3 averages for you guys of the Fibonacci numbers. Okay, we've used the 5, the 13 and the 21 moving average. That's a daily moving average, okay? And with reasonable spacing between them, this should give us a smooth price database. Now, you can set these moving averages on your trading platform charts with ease in the Add Indicators section, and hopefully you know how to do that, okay? So, moving forward, once we have these 3 averages on our charts, we're looking for simple crossovers from the low to the high in the case of an uptrend, and from high to low in the case of a downtrend. Specifically, for example, okay, the 5 sample moving average will cross over and above the 13 moving average, and the 13 moving average eventually over and above the 21 moving average, to give us that confirmation, as you can see here, of a buy side signal. Okay, now in the reverse case scenario where you're looking for downtrends or sell side markets, we're looking for the shorter term moving average crossover to move below the longer term Fibonacci based moving average and towards the sell side, as you just saw from that chart there very clearly. Okay, so the reversal is actually what's giving us our trend signal, and through the use of this average crossover. Now it sounds great, but what about the instances where the averages don't follow through? In other words, what about my risk management? And the big question, obviously, which is critical for every trader, guys. Risk reward is what it's all about at the end of the day. One of the beauties of this strategy, guys, in fact, as traders, is that it allows for tight risk management, which is something you might want to make a ground rule. Now, you can see from the moment we get the Fibonacci averages in this chart crossing over and giving us our sign or signal, it is safest to prepare your stop loss just above or below, in a buy-side market reversal as opposed to a sell-side market, the previous market high immediately prior to the crossover. So I'm going to say that again. If you're trading a bullish market, an upside moving market, okay, you will need to prepare your stop loss just below where these moving averages, these Fibonacci moving averages, are crossing over from each other. Okay, and that should be a reasonable, safe, tight management guide for you. Okay, and there you can see here the sell side market, the same is true, just above the crossover of the moving averages. Okay, so there you have it, guys. It is simple and safe. And don't forget to please check out the Trade Genius community on our Facebook page and exchange your market ideas with the world. Thanks for listening.